What if I told you that the world's most successful investor built his fortune not by predicting crashes, not by chasing hype, and not by reacting to every headline, but by doing almost the exact opposite of what most people do during uncertain markets? When fear spreads across Wall Street, when headlines scream recession, inflation, or market crash, Warren Buffett doesn't panic. He doesn't guess, he doesn't speculate. He follows a simple, disciplined strategy that has worked for over 60 years. And today, I'm going to break that strategy down in a practical way so you can actually use it in uncertain U.S. markets. Welcome back to U.S. Finance Insights, where we simplify the U.S. economy and investing so you can make smarter financial decisions. If you value clear, practical investing advice without hype or speculation, make sure you like this video and subscribe to the channel right now. It helps us grow and keeps this kind of content coming. Let's start with something important. Uncertain markets are not new. We've seen the dot-com crash, the 2008 financial crisis, the COVID crash, inflation spikes, rate hikes, and banking fears. Every time, people say, this time is different. And every time, most investors either panic sell at the bottom or chase risky assets at the top. Warren Buffett built his strategy around one core belief. The market is unpredictable in the short term, but very reliable in the long term. Buffett does not try to time the market. He does not sit in front of a screen guessing whether the S&P 500 will go up next week. Instead, he focuses on owning great businesses. That's the first pillar of his strategy. He doesn't buy stocks, he buys businesses. That mindset shift alone changes everything. And when you buy a stock just because the price is going up, you're speculating. When you buy a business because it generates consistent profits, has strong management, competitive advantages, and long-term growth potential, you are investing. The second key principle is long-term thinking. Buffett once said, "Our favorite holding period is forever." That doesn't mean you literally never sell, but it means you invest with patience. In uncertain markets, prices move fast, fear spreads quickly. But strong businesses don't change overnight. Coca-Cola doesn't stop selling drinks because the market is down 10%. Apple doesn't lose its ecosystem because of one bad quarter. Buffett focuses on decades, not days. This long-term mindset protects you from emotional decisions. Most investors lose money not because they pick bad companies, but because they react emotionally. They sell when prices fall and buy when prices rise. Buffett does the opposite. He famously said, "Be fearful when others are greedy and greedy when others are fearful." In uncertain U.S. markets, this principle becomes extremely powerful. Let's make this practical. When markets drop and everyone is scared, high-quality companies often trade at discounts. That's when Buffett becomes interested. He doesn't buy everything. He waits for value. Which brings us to the third pillar, margin of safety. Margin of safety means buying a great business at a reasonable or discounted price. Even a strong company can be a bad investment if you overpay. Buffett studies financial statements, earnings consistency, debt levels, and long-term competitive advantages. He wants to make sure that even if things don't go perfectly, the downside risk is limited. For everyday investors, this can mean focusing on profitable companies with strong balance sheets and stable cash flow, especially during market pullbacks. It can also mean using diversified index funds if you don't want to analyze individual companies. Buffett has even recommended that most people simply invest in a low-cost S&P 500 index fund and hold it long-term. That alone tells you something powerful. You don't need complex strategies to build wealth. Another important part of Buffett's approach is avoiding speculation. In uncertain markets, people get tempted by trending stocks, hot IPOs, or viral investment ideas. Social media can make it worse, but Buffett stays in his circle of competence. He invests in businesses he understands. If he doesn't understand how a company makes money, he skips it. That discipline protects him from massive losses. Think about this. You don't have to invest in everything. You don't have to chase every opportunity. Sometimes the best decision is to say no. In uncertain markets, protecting capital is just as important as growing it. Now let's talk about cash. Buffett often keeps large amounts of cash when he doesn't see attractive opportunities. Many people criticize him for this during bull markets. But when markets fall, that cash becomes powerful. It gives him flexibility. It gives him confidence. It allows him to invest aggressively when others are forced to sell. For you, this might mean maintaining an emergency fund and not investing money you may need in the short term. It also means not being fully leveraged. Debt during uncertain markets can destroy your portfolio. Buffett avoids excessive leverage. He understands that survival is the first rule of investing. If you survive downturns, you can benefit from recoveries. Let's connect this to today's uncertain U.S. market environment. We have inflation concerns, interest rate changes, geopolitical tensions, and economic slowdowns. It's easy to feel nervous, but ask yourself, will strong American companies still be operating 10 or 20 years from now? Will people still use technology, buy consumer products, need healthcare, and use financial services? The answer is very likely yes. Buffett invests in the long-term growth of the U.S. economy. He has repeatedly said he would never bet against America. That doesn't mean there won't be volatility. It means that over time, productive businesses create value. By owning those businesses, you participate in that growth. Here's a simple framework inspired by Buffett that you can apply today. First, focus on quality. Look for consistent earnings, manageable debt, and durable competitive advantages. Second, think long-term. Invest money you won't need for years. Third, demand reasonable prices. Don't chase hype. Fourth, stay emotionally disciplined. Avoid panic selling. And fifth, keep some liquidity so you can act when opportunities appear. Notice something important. None of this involves predicting next month's market direction. None of this requires complex charts or daily trading. It's about behavior, patience, and discipline. That's why Buffett's strategy works especially well in uncertain markets. When others are emotional, disciplined investors gain an edge. Let me share a quick example. During the 2008 financial crisis, markets were collapsing. Fear was everywhere. But Buffett invested billions into strong companies at attractive terms. Those investments generated massive returns in the following years. He didn't know the exact bottom. He didn't wait for perfect clarity. He acted when value appeared. The lesson is clear. Uncertainty creates opportunity for prepared investors. But preparation happens before the crisis. It happens through research, saving cash, controlling debt, and building emotional discipline. At US Finance Insights, our goal is not to help you get rich overnight. It's to help you build sustainable long-term wealth using proven principles. Warren Buffett's strategy is not flashy. It's not exciting on a daily basis. But over decades, it has created one of the greatest track records in financial history. Before we wrap up, let me challenge you with a mindset shift. Instead of asking, what will the market do next month? Start asking, what businesses do I want to own for the next 10 years? Instead of asking, how can I double my money quickly? Ask, how can I reduce my risk of permanent loss? These small changes in thinking can completely transform your investing results. Uncertain markets will come and go. Headlines will change. Analysts will disagree. But disciplined long-term investing has stood the test of time. If you follow Buffett's principles, focus on quality, demand value, think long-term, control emotions, and stay within your circle of competence, you put the odds in your favor. If you found this breakdown helpful, drop a comment below and tell me, are you investing for the long term, or are you still trying to time the market? I read the comments, and I'd love to know your perspective. And if you think someone you know needs to hear this message, share this video with them. It might change the way they invest during uncertain times. Thank you for watching US Finance Insights. Stay patient, stay disciplined, and remember, long-term investing is not about predicting the future. It's about preparing for it. I'll see you in the next video.